right. Good morning. Good morning. Welcome in second day of the crowdfunding, Silicon Valley crowdfunding, fifth annual Silicon Valley crowdfunding. And this is my favorite section. It's a round table. And so we do that, and it's very, very open. So we can ask questions from our expert. We have Michael, we have Joan, we have Jean, myself. And we're going to have you guys kind of ask question, but you could have your opinion. But for audience at home, so asking question because we're going to be there's going to be tape and it's going to be in CrowdFund Beat. But when you have a comment, keep it to about minimum about 1 to 2 minutes, and we don't want to go for over. So, but when you have a question, so we're going to have everybody input. An expert will talk about it. So the discussion is going to be about crowdfunding, crowdfinance, and we can be discussing about basically whoever not been in the crowdfunding, who has been in the crowdfunding. So ask question. There's no, a lot of people, this is a very new industry, and so a lot of things is unknown, a lot of things happen, but still, we're evolving to the right, to becoming the right industry. But also we have other people that, they're relating themselves, they're in other industries, so we have like you, and they want to be connected to how to do raising money. So on that regard, I'm going to give it to Jean. Jean's going to be our moderator, and Jean's going to be asking questions. I'm going to hang out and give the microphone so we have some audio over here. Thank you. Good day, and I'm looking forward to this discussion roundtable. Thank you. Yeah, please.
Sydney, you do a good job.
Sydney does an excellent job.
He does.
Without that, we won't be here.
Sid,
You're here because we have thanks to our sponsors. That's very
No, but still, you put your soul and heart in making this happen.
so, Sydney really does an excellent job. There's no, I do a lot of conferences and there's nothing like this. This is really incredible. It gives an opportunity for people like yourselves to ask questions and for the sponsors to help them and answer their questions. Michael, you are an expert in EB5. We got a call last night at 6:30 for our deal for the Broadway show starring Clara Bow about a person inquiring about an EB5. So if you could kind of walk us through in just a very easy summary in a minute or two how an EB5 might work with someone in China.
So the answer is the EB5 aspect of the investor providing financing for your business is really no different, or is only different to a small degree in that investor contributing financing without doing EB5. Obviously, what he needs to do is he needs to invest the minimum amount, which is depending upon whether or not your business location is in an area of high unemployment, in which case it's the $500,000 reduced minimum.
And that has to be 1.5 times the minimum?
Right. A high unemployment area is 1.5 times the national average, which is approximately 5% right now. So that would mean that the area has an unemployment rate of 7.5% or higher, and it qualifies.
And that would qualify you for the 500,000?
That would qualify the investor for being able to invest the minimum amount, which should encourage him to invest with your business as opposed to a business that requires he put in $1 million. So he puts in the minimum investment amount. He then engages an immigration attorney to file a petition with the U.S. Immigration Service.
And that's you, right?
Well, we're actually securities lawyers. So what we do is we would write the investment papers for you as the business owner that's receiving the money.
So I still need an immigration lawyer in addition to the...
You don't, but the investor does, because the petition that he or she files is a personal petition. They're getting a personal green card. It's a benefit that's only given to people and not companies. So if they happen to have a company, they cannot invest through their company. They have to make a personal, individual investment. They get to include their spouse and their minor children as part of the benefit, but it's an individual claim. They engage an immigration attorney who helps them fill out the petition for what's called the conditional green card. And that's awarded to them after an adjudication process that 7 years ago used to be 2 to 3 months. Because EB-5 is so popular and it's so flooded, it's now taking the government 13, 14 months to adjudicate that petition.
So in the meantime, you get a temporary green card.
So you get a temporary green card when the petition is adjudicated. Their investment dollars are usually applied into the business immediately, or perhaps when you've accomplished certain milestones, like you've finally gotten all of the capital that you need for the project put together. Then you're able to access the investor's capital. It goes into your business along with the money from all the other sources. And then you need to create those 10 jobs that are going to be credited to that investor, not immediately, but only 2 years later.
So 2 years later, I better have 10 people employed.
Right.
And it can't be the people that are looking for the green card, right?
That's correct. It has to be Americans, citizens or residents, not including the investor. And if after the end of 2 years, you can demonstrate that those jobs exist, and the easiest way is to show the direct jobs by showing your payroll to the Immigration Service. They'll look through and make sure that those are 10 jobs that didn't exist 2 years ago, and then they'll say, yes, the investor has satisfied the obligation through you. He's happy, he gets a green card for himself and his family. You're happy, you've been able to get his funding and apply it to your business, and the U.S. is happy because 10 jobs were created, not because of our taxes, but because this investor made this investment.
Okay, in the case of this, well, have we got a question?
Everybody in that family count as, quote, one entity?
Yes.
Actually, that's a great question. Unfortunately, no.
The question, 'cause
The question was, does the entire family unit count as one investor, one green card? And the answer is no. Actually, out of that 10,000 number, green cards are given both to the investor and to the spouse and to the children, if any. But what that means is out of that 10,000 total, that's not 10,000 investors. That's 10,000 investors plus spouses plus kids. And the Immigration Service says there's an average of 2.5 green cards per investor, which means out of 10,000 investor green cards, you're really only getting about 3,000 or 4,000 actual investors. So there has been a request made by the industry that we not count those family green cards that are called derivatives, because now that there are more people than 10,000 who would like to invest, we should just use those 10,000 for the investors so we could bring in more investment money and create more jobs and more businesses can get funded. And yet those, the family members would still receive a derivative green card, but the derivative green cards would not count toward the total. Hopefully that'll happen, because that would mean that the U.S. can receive a lot more investment money.
Here's a hard question. Let's pretend there's a family in China right now, a man and his wife and 2 kids, and they want to come here and they want to do the EB-5 thing.
Yeah.
How long before, and they write a check, $500,000, let's say.
Yep.
How long before they can enter the country and get a temporary green card?
Well, the best answer is to ask that question of the immigration attorneys, since they're the experts.
What's your experience in roughly?
Our experience has been that they will not get the conditional green card for a period of over a year. However, there are usually ways in which investors can come into the United States on other kinds of visas. And if they are eligible for any other kind of visa, the fact that they may have an EB-5 petition that's been filed and is waiting and waiting
helps.
It doesn't hurt. So they are allowed to be in the United States on any other kind of visa that they qualify for while they're pursuing an EB-5. They're waiting for the government to get around to their EB-5 petition.
Okay, great.
Pass the microphone. Thanks, Gene. Thanks, Michael. My pleasure. Very useful information, and it's very fascinating about EB-5 and what's going to be developing after this immigration. So I'm going to pass. I know you have any question, but let's go around the table, and I would like everybody to introduce themselves and say what profession they are, so we can just kind of know each other. I know we did that yesterday, but for this roundtable, we would like to know that. So I'm going to start from here. If you don't mind, I'm going to hear. Go ahead, sir.
My name is Rama Rao. As I told yesterday, I'm an entrepreneur based in Long Island, New York. And we are combining 2 technologies, solar technology and fintech. And our hope and desire and wish is to raise capital through the equity crowdfunding. Thank you.
Thanks, Rama. And, sir.
Yes, hi. My name is John Chow, and I'm a co-founder of a life science company. It's based in Canada, and we will be developing products, natural health products, which will also include cannabinoid-based products. And we are also have offices in Southern California where we're going to be doing most of our product development and R&D.
Thank you. Is this coming? Oh, good. That's good.
Yeah. My name is Christine. I'm a licensed attorney in China, but right now I'm a PhD student in Emory University Law School. My new project is about regulations of equity crowdfunding, both in China and the U.S.
Oh, great. Thank you. Joan, if you don't mind.
I'm Joan Dromey. I'm the product manager for the private markets group at ComputerShare. We're a stock transfer agent, and we do record keeping for privately held companies.
I'm Marlene Bellstock from RMB Real Estate Enterprises, LLC. I'm here to learn about crowdfunding and to get an education, and we hope in our company to start using crowdfunding. Oh, and we're located in San Jose.
Don't steal that mic from me again. Hi, everybody. I'm Dave Blankenship. I am out of St. Louis, Missouri, and I'm initially going for writing a book on equity crowdfunding for entrepreneurs. However, I'm looking to gain experience in helping entrepreneurs in the St. Louis area raise equity crowdfunding, and so I'm here to learn. Thank you.
Hi, my name is Kame Che. I work with a group called CrowdFund Capital Advisors, who are the primary lobbyists for the Jobs Act. And I've been consulting on behalf of them within Asia and dealing with the regulations over there and creating new frameworks. And currently now consulting with financial incumbents and trying to advise them how to use crowdfund technologies within the existing systems and help them.
Hi, I'm Bob Bellstock here as an investor and CPA. Been asked to come here to make contacts and to raise funds.
Hi there, I'm Bob Goldman. I'm an individual investor from Arcadia, California, near Pasadena, and I invest in multifamily and commercial real estate, primarily in Memphis, Tennessee these days. I'm here to learn about more about the viability of crowdfunding as a pathway for me to grow. Thank you.
Hi, I'm Guy Noyes. I'm a lawyer. I guess I call myself a crowdfunding lawyer, but I also do IP and business law. And I'm here to meet people, hear what's going on in the industry, make sure that I've got my hand to the pulse, and yeah, make some connections.
Yes. Hello, my name is Farid Dean, and with Ayadi Pro Tech Solutions, we are specialized in building web application and mobile application for entrepreneurs and startups. And also we provide them with digital marketing solution. We are a certified partner with Google and Bing. I'm here today just to learn how the crowdfunding as alternative for the entrepreneurs and the startups we work with. And also to network with the great people like yourself. Thank you.
Good morning, everybody. My name is Susanna Lam, and by trade, I'm a tax CPA and a financial advisor. But I run a company. I'm an entrepreneur. So I run a company that focuses on the 5 pillars of health, which are emotional, mental, physical, financial, and spiritual. So I would like to be here to learn more about financial, fintech, and crowdfunding so that it will be incorporated into my business and help other people.
Hi, I'm Barry Fosman. I'm the CEO of a company called Star and Clarabeau Incorporated. We're a Broadway musical written about the life of Clara Bow, the silent film star, and I'm the composer.
I'm Jayant Ishwar. Work with a company called Early Growth Financial Services. We provide CFO and accounting services to small startups, and some of my clients are looking at crowdfunding. That's the reason why I'm here, to find out more.
I'm Monica Hujazi. I've been a consultant and a licensed real estate valuer by the state of California for over 30 years. I'm a heavy real estate investor. I was invited personally by Sydney to open my eyes to another vehicle on funding. I am familiar with EB5s because some investors come to me. I also have worked on some large developments in Oakland, one being the Emerald Park right now. So the area of real estate valuation and advising is my strong arm. I've also now, because a lot of my clients over the years are getting older, I opened up another whole team to advise people on protecting their assets and having retirement plans and life insurance to make sure that I call it a gift for their wife and their kids or their husband on a subject that we don't think too much about, but it's a very important issue. My mom was on feeding tubes for 7.5 years and left me with a mess. And it cost me over $10 million. So I want to give all you here a shocking, shocking statement, because if you love your wife, you love your husband, you love your kids, do not do what my mom from Europe kept on saying, tomorrow, tomorrow, tomorrow on, because tomorrow comes today at some point in each one of our lives. And my mom would have never wished, I'm the only child, my mom would have never wished this on me, would have never wished this on her only grandchild. And I made a whole bunch of lawyers very, very wealthy. And I don't think that was either my father's wish that passed away a lot earlier than my mother, or my mother's wish. So sit up, take note. And if that's something you put tomorrow, contact me, because I'll put somebody on my team to have that tomorrow be today, and, you know, give your wife for Valentine's a present 10, 20, 30 years from now, so she's not left with a mess. I just say, give them a present, give your children a present, because if you look at it in a form of a present in your life to alleviate crises upon crises upon crises, you're making a difference in the world. It was the last thing my mom would have wished for me. So I have taken a lot of my wealthy clients and said, sit up, don't do what my mom did. And obviously I feel like I'm a shepherd and a calling in doing that. After 30 years of being an advisor, and I worked with very, very, very wealthy investors all over the U.S. before we became state regulated. So I love that world. Forwards and backwards. I work on very complicated cases, so if you do crowdfunding for real estate, come to me. But more importantly, now I have a whole team, and my team is growing in regards to shaking up awareness.
I'm Leah Goldman. I do marketing and nonprofit consulting, and I'm interested in learning about social impact crowdfunding.
Hello, my name is Reese Morgan. I'm the founder of Hudson Morgan Investment. We're a private equity investment company, and last year we incubated a company called CubeChain, which is technology company built around the blockchain industry and healthcare and its supply chain. And Hudson Morgan Investment has now automated a lot of its processes, and we have a funding portal that we're bringing out, and we're bringing it out on the CubeChain platform so that people can invest around the blockchain industry.
Hi, good morning again, everyone. First, I want to show appreciation to this lady who just reminded me for the Valentine's Day. I think I owe my wife too much, and she has done too much to me. I have done too little. Thank you very much. My name is Joseph Pei, co-founder of Pinshow Inc., located in Fremont, California, and Beijing. We are doing mobile app. I came here to learn co-founding the system, the structure from you. So for the last 2 days, knowing you persons is a gift to me. I really appreciate this opportunity to me. So I'm also working as a consultant of several high-tech projects which are fantastic. If you like it, if you are the investors or angels, feel free to contact me. So anyhow, thank you very much. For the last 2 days, my English practice is more than 2 months of my time. Thank you.
And now we get to probably the most important part of our morning, and that is getting some real good information. And Joan, you are with ComputerShare. Now, when you're doing crowdfunding, obviously the whole purpose of crowdfunding is getting a little bit of money from a lot of people. You've got a big crowd. And so would you like to tell us how you take care of the shares and all the different shareholders and basically describe how a crowdfunding works and how do you keep all those records and stock certificates or things like that? I want to pass that. Yeah.
Thank you, Jean. I would say that one of the things that people need to be aware of when they do crowdfunding is that you can have a successful capital raise, you can fund your company, and that's only the beginning. People think sometimes that that's the end goal. It's not. Now you have money, and you also have investors. So you have to deploy the money wisely, and you have to look after your investors because they've given you their money, and they're going to want to know how that money is doing and how your business is doing. One of the things that ComputerShare does is we keep the books and records for who owns the securities in a company. Now, companies structure their capital differently. Some companies, it's nothing but common stock. Other companies do several different security issuances. So maybe they do a Class A stock issuance. Maybe they have preferred stock. There are all different types of structures. We see a lot of companies that come into us that maybe they started out with a handful of people, probably fewer than people in this room, and then they decide to do a Regulation A+ offering. So now they're going from having 27 investors to maybe having 5,000 investors. So when you have 10 or 20 people, it's a little easier to keep in communication. Sometimes it's not that easy to keep your records straight, but people try. But it's important as you grow to keep that information or have someone keep it for you in an accurate manner. These days, the best way to do that is to put it in a digital format. Not everyone has done that. So we've had lots of situations where companies come in and if they raised capital from their friends and family 5 years ago, maybe they issued certificates. Because when people buy stock in a private company, actually venture capital firms are the worst offender in this regard. Sometimes they demand paper certificates. I'm here to tell you that paper certificates are a really bad idea. People lose them. They claim that the dog ate them. They claim that they can't find them. And unfortunately, when you have that situation, because securities are negotiable, when you have lost certificates, there's a cost involved in replacing them. No one likes to pay that insurance premium. No one at all. And it's amazing how many people can find the certificate when you tell them it will cost money. Amazing. It's just an amazing thing that happens. As soon as it costs usually 3% of the estimated market value. Yeah, a lot of money. So it's amazing how many people manage to scramble around and find it once they realize there's money involved. So it is magic, but you can't cancel it unless you actually have it. So if it truly has gone missing, we have to report it to an agency called SIC, which is the Securities Investor Corporation or whatever. And so we transmit a feed every day because what happens when people find a certificate, let's say, grandma dies and people go through all the stuff and they find old stock certificates. Well, then it's a little fun treasure hunt to find out if any of them are actually worth something. To do that, they usually take it to a broker-dealer, and then the broker-dealer has to hunt around and find out if Company A was taken over by Company B and later became Company XYZ. You have to kind of trace it through and find out if it actually has value. Many times what happens is someone reported the certificate lost, and it was canceled off the books. But if someone doesn't realize that, if a broker gets a certificate and they try to negotiate it or sell it, people could be out the money. Think of it as it's like the title to your car. You're probably, if you're selling your car, the person that's buying it wants the title to prove that you really owned it and had the right to sell it to them. If you don't get that title, then even though you might drive away in the car, it's not really yours. And if the person that's selling you the car doesn't get your money, then they can be out the money. So that's what happens with stock certificates. You have book entry shares, which is what people are used to with mutual funds. Mutual funds have always been paperless. So really all you have there is a statement, and the statement is the proof of ownership. So it's much more common these days for people to keep the records electronically, and it's also better because it's harder to lose it. It still can be done, but that's why it's a good idea to outsource to another professional that keeps records, whether it's a stock transfer agent, your attorney, maybe your accountant. People try different methods. Depending on where a company is in terms of its growth, they may do different things. Once you get into the land of having several hundred investors, you don't want to keep doing this yourself because it's not glamorous, it's not that much fun, and it's really important that it be accurate. So what we see with crowdfunding is people are expanding to have thousands of investors, and they need a means of making information transparent and accessible to those investors. People like to be able to log into a web portal and see that I really do have 800 shares and they're really worth this much money. And I feel comfortable when I can see that. And it's also, doing that gives you a method to communicate with those investors. So we provide those types of services. We also have a web portal for the issuers where they can log in, they can see their entire capital structure, they can run all kinds of reports, they can upload sensitive information in a secure portal, they can see all of the investor information. Because when you're out raising capital as the founder of a company, a lot of times you'll know the investors. They may call you personally, so you may need to look up the information. So there's a portal that makes that information available to the issuers.
I bet people here have questions, and now's your chance, because Joan has a wealth of information. And Joan, if you would repeat the question in case the mic doesn't pick it up.
Okay. Yes.
I've got a question, especially for you, Joan. How vulnerable do you think the crowdfunding industry, or Title III specifically, if you want to talk about Title II and Title IV, that's also great. But how vulnerable do you think those industries are because they're so new? Title II less so, but Title II
Title II is really not new, although the general solicitation part is new. The question is, how vulnerable are different segments of the Jobs Act in terms of crowdfunding, because it's a new industry? I think one of the things to keep in mind is that securities laws go back 80 plus years. Actually, we're working on more like 100 these days. So it's important to realize that crowdfunding is a new tool for companies, and it changed the landscape in terms of general solicitation and kind of widening the pipeline to allow different types of investors into what formerly were sort of, people used to call them country club deals, because mostly they were limited to accredited investors, which is people that have an income of $200,000 or more for the past 2 years and expected for this year, or a net worth in excess of $1 million. So crowdfunding has widened the playing field a bit. I think the vulnerability comes in the fact that there's still a lot of new players and novices in the space, and people are still figuring out what works in terms of business models if they're funding portals, especially on Regulation CF, the Title III deals. They're smaller, it's startup companies. There's a lot of figuring out still going on, and trying to figure out what works from both a cost perspective and a fundraising perspective, not to mention once you get the funds, you have to get your business going. So I think that that's vulnerable because startups inherently, kind of like the restaurant business, there's a high failure rate. So I'm not sure what the toleration will be in the investor community or what kind of appetite people are going to have for failure rate. It may be that people will be smart enough to spread out their investments so that if I think I want to play in that space, maybe I put money into 10 companies and not one, because I might hit one that's going to give me a really good return, and it's likely that some of the others will fail. So I'm not certain we know enough. There's not enough data out there to tell us how that's really going to shake out. In the other end of things, the Regulation A+, it's sort of the return of the old-style IPO. IPOs have gotten to be very costly, that going public route. It costs companies millions of dollars, and they gain liquidity from it. But the space for Reg A Plus is really companies in that kind of $20 to $50 million range, which have kind of been priced out of the public IPO market. So I think that's a really good thing. I think that the lack of understanding there in the investor community has probably been that these aren't startups. I don't think I've seen one yet that is. These are companies that have track records, because if you're out there raising $50 million, it's probably not on a wing and a prayer and a fine idea that's unproven, okay? So Regulation A+, I think, will be a big success. It's going to take time to gain some traction, because the one aspect of that, I think, that hasn't been figured out is the distribution of the investments. How do you sell the investments? Because that theory that if you build a portal, they will come, maybe. I don't really believe in that. I don't think most people wake up this morning and think, I'm going to run out and buy a private placement. Yes, even though I'm not accredited. So I think that the distribution of Regulation A+ is the bigger challenge. And I also think the secondary challenge there is how to deal with the lovely issue of liquidity. Liquidity is important to people, but how much liquidity do you really need? And if you're putting funds into a Regulation A+ offering that really you need in July for your kid's next college tuition payment, you're making bad decisions with your money. That is not the money you should be putting into that investment. So I think that that kind of issue...
Can you describe a good investment?
Can I describe a good investment? I think there's lots of good investments out there.
Let's pretend I've got a portfolio and
Okay.
I've got a lot of different stocks and things. When would be a good time to make some of these startup investments, and how much should I put in? 10%, 5% of my...
People say, if you talk to family offices, and I'm sorry, Jean was asking what kind of allocation should people put of their portfolio into investments like this. Like anything else, it goes to your risk tolerance. So if you're someone that really wants to be clipping coupons and you want very safe investments, probably almost none. But if you talk with family wealth offices and venture capital type people, private angel investors, a lot of people feel that about anywhere between 10 and 20% of your portfolio should go into alternative investments. Think about the fact that these investments are somewhat insulated from market risk, because when you invest in the stock market or the bond market, not only are you investing in that actual investment, you're investing in something that plays in an open market that has a life of its own. So you can own a stock that's a perfectly good stock, and if the market suddenly takes a dive, your good stock is probably going to dive right along with it. It doesn't mean that the fundamental goodness of that investment has changed. It means that the market has taken on a life of its own and is taking your money for a ride with it. And that just happens. When you invest in private placements, they're not subject to market risk. So one of the challenges for Regulation A+ is it creates a fully tradable security, and there are people that feel very strongly that liquidity is a very important component, and those stocks should be traded. There's another crowd of people, and I think I put myself in that category, that don't think liquidity is the be-all, end-all, and that don't necessarily think that trading on an exchange or listing on OTC is the best path for all Regulation A+ securities. Once you do that, you're then subject to market risk, even though you have liquidity. So it's a trade-off.
Can you give an example of liquidity without being in the market? How would I
Yeah.
get rid of my shares if I'm not in the market?
Jean's question is, can I give an example of liquidity without going into the market, and what are the options for investors who might be looking for a way to trade their private securities? There are some options there. The most popular one, I would say, or the one that's gaining popularity, is to do some sort of structured redemption program. We have a client that has a number of Regulation A plus funds, and they do a quarterly redemption. So as an investor, if I want to sell my shares, every quarter I have a chance to tender a certain amount of those shares. There's a minimum that I must tender, so they don't want people coming in and saying, I need to sell 5 shares. You're selling them back to the fund. It's a buyback. Yep. So very similar to a mutual fund, if you've ever owned mutual funds. When you sell your mutual fund, if it's an open-end fund as opposed to a closed-end fund that trades on an exchange, you are literally selling it back to the fund itself. And that's the approach that some Regulation A plus issuers have taken.
John, question.
Mm-hmm.
How do they determine the value?
The question that John is asking is, how do they determine the value of the shares? For some companies, that's a reasonably easy proposition. Real estate, as this lady down here was saying, she's a valuation expert. So valuing real estate is, because it's a hard asset and because you can look at the economics pretty closely, you can arrive at a net asset value for a real estate portfolio fairly easily. Operating companies are a little more challenging. And valuation is not an exact science, and there's a number of methods out there. But when companies publish a valuation for their securities, they're required to disclose that methodology to you. How they arrived at the value of the asset. So we have a number of private clients where we support publishing a valuation of their securities. And with that valuation, there's always an as-of date, because on a private security, it's a look-back. It's not today's trading that determines that value, as if you're looking at AT&T or Walmart or Federal Express or an exchange-traded stock. So the day's trading determines that price. However, if you're doing valuation on a private security, at some point in time, someone went in, they looked at the full portfolio, or they looked at the operating company and the financials, and that's an after-the-fact determination. So when I published the valuation, it would say that Class A common stock is worth $9.82 as of, January 31st, 2017. That doesn't mean that that's what it's worth today. Could be more, could be less. But that is what it was worth at the time that I had the information to make that determination.
Julie, if I can ask, is your company make the determination?
Absolutely not. The issuer will generally take one of 3 methods to determine the value. They may do it internally with their accountants, and there are FASB standards that they have to adhere to and different methodologies to be used in that. They may hire their outside accountants to do that. They may hire a business valuation firm to determine that.
Does your firm endorse the valuation?
Nope. In fact, we show a disclaimer that says we have no idea whether this is valid or not.
Will not have a comfort factor that you guys are behind the valuation of the company.
We have nothing to do with the valuation of the company.
I can tell you this from a lawyer's perspective, a securities lawyer, you've got to include in the papers that we write for the company to give to its investors, you've got to explain what's the company's policy going to be on redemption. And you've got to tell them this is how we're going to cash you back, this is when we're going to cash you back, this is how we're going to figure out how much your shares are worth from time to time to time. That's a material piece of information that investors need to know before they make the investment. Our job is to make sure that that content is included in the investment papers when the investors are considering making the investment. And of course, once the company puts that information into the investment documents, they tell us what to include, and we write it up nicely and clearly so that people can understand it. Then, of course, the obligation is they got to do it. When the time comes, they're locked in, and they have very little freedom without going out to all of their investors if they want to make a change. They've got to do whatever they decided sometimes years earlier was going to be the way that they were going to exit investors, and do it that way, and find themselves sometimes down the road years
locked into a system that really doesn't work for them, and to change that, they've got to go back to their investors and say, it's okay with you if we do something different because what we had planned before doesn't work anymore. But remember, this is information that needs to be given to the investors at the time they're coming in. So you as the business owner, or you who are the person working with the business owner, you've got to tell them what's your policy, and that's got to go in your investment docs so your investors know what's going to happen and what's not going to happen when they're making the decision, and then you got to do it.
If I can, right?
Well, no, you always have to state your policy. Yes.
If you are issuing, suppose, 10 million shares, right, on a certain valuation, as you are saying that, they have a methodology to determine what the value of the stock is. Now, after 6 months down the road, who determined what the value of the stock is? Like Walmart or the Home Depot, everyday stock will go back and forth, right? For a private shares, who determined what will be the value of that stock? And how does the investor who wants to cash out certain portion will agree with that valuation?
There's a couple of ways that can happen. If the company is publishing a valuation 6 months later, 2 years later, 5 years later, they're still probably working on the same methodology they start with. They're either doing it with their internal financial folks themselves, they may be using an outside accountant, a CPA, to do it, or they hire a business valuation firm. And that's probably stated in the disclosure documents that you look at when you evaluate the investment.
So they need to communicate with you guys for you to update the value of the share?
Correct. We actually have a tool in our issuer portal where they can simply enter the information. So they enter the price, the as-of date, and the explanation about how it was calculated, and that carries through onto our investor web portal and onto statements. So that's how they're publishing it. What we say is that the valuation, that it's a privately held security, it's non-traded, and that the valuation was provided to us by the issuer. So we state that. Now, the other way that a value can be arrived at is, a value of anything can be arrived at on a transaction between a willing buyer and a willing seller. So on privately held companies, you will sometimes find that shares will trade if there is a market maker for the stock, and I see this quite a bit with privately held banks. So you'll see there's a market maker for the stock has a CUSIP and usually a ticker symbol, and it trades over the counter. That does not mean that that is a publicly traded security or a publicly held company. However, what you find is if there's a market maker, and think of the market maker as the difference between a market maker in this situation and an exchange like the NASDAQ or the NYSE is, the exchange an exchange is like, it's like Macy's. It has published hours that it opens and closes. It has particular ways of doing things, and stuff is arranged in a certain way. People come in and they buy and sell on certain terms. And it's all completely above board, fully disclosed, and incredibly transparent. Other markets are not quite that clear. So think about the OTC or any ATS, automated trading system, as it's more of a, you're buying a custom suit. You go in and you say, I'd like something like what Jean's wearing. Can you make me one of those? Only I'd like it to have pink stripes and I want it to be tailored to fit me. Okay, so it's a custom situation. So the market maker is going to take your buyer wish and go off and find a security that fits it, or you may be bringing in a custom item and saying, I would like to sell this. Can you find someone that will buy it? So that is a lot more of a, let's call it a less transparent situation. There's a higher markup involved because it's a custom transaction in essence.
So OTC can trade both the public stock and the non-public stock also?
Yes, it can. It's the trade is processed through OTC, but the market maker is really making the trade, and OTC is not a market maker. No. So it's the market maker that's doing it. Yeah. There are people that find buyers and sellers every day. So you may see a situation with a privately held stock, and you'll see it quite a bit on private banks, where someone wanted to sell the stock and someone went off and found a buyer for that stock. But stocks like that are generally what they call thinly traded. So you might look at something like that, and the last trade on the stock took place 2 months ago for a block of 1,000 shares. There might not be another trade for another 3 months.
Now I want to add, Facebook, before they went to IPO and all these things, right? It's a secondary place. They do trade. Like if you look at this high-tech company in the California, right? Like Snapchat or Facebook or the Google, all these stock traded in the secondary marketplace before the IPO. Who trades them? Which organization put the buyer and the seller together? Like Facebook stock.
Yeah, that's exactly the situation that I'm describing, really, is you have someone that wants to make a market, you have someone that wants to sell something, and there's someone out there that's willing to broker that transaction.
Do you have the names of those companies?
Stockcross is a market maker. I mean, it's going to really vary, Rama, from stock to stock. So if I have shares of Snap and I want to trade them before the IPO goes off, I can look around for a market maker. I may be able to find someone that will do that.
Is it a publicly available information? If I Google it, I will be able to.
You might be able to find it that way. I wouldn't be surprised.
Because all this issuer in a private market need the secondary market liquidity, what you call it.
And there are
Day-to-day valuation.
And there are companies that are starting to work in that space and do secondary market trades. If you own non-traded REITs, there's a couple of platforms that do secondary trades. Mackenzie Securities does. They're in California. So they kind of specialize in trades of non-traded REITs, which are privately held. They're not traded on an exchange, but there are people looking to liquidate their positions, and there are people that will buy them.
Because financially it makes sense for them to trade these thinly shares.
The broker is always going to make money. Okay, it's kind of like being in Vegas. The house always makes money.
And as a clarification, the market maker would work for McKinsey Securities that would bring the buyer and seller together?
In the case of Mackenzie Securities, I believe they're acting as the broker for the transactions. The market maker is always essentially brokering the transaction, no matter who it is in that secondary trade market.
Okay. So McKinsey was one example, but there are other
Stockcross has numerous market makers.
What about if I want to sell my private shares to my Uncle Charlie?
Jean's question is, what if I want to sell my private shares to my Uncle Charlie? We actually have, as a stock transfer agent, we have a form on our transfer paperwork.
The Uncle Charlie form?
The Uncle Charlie form. It's a little section called private sale, and you provide the terms of that sale. So, Jean, if you negotiate with Uncle Charlie and you guys come to, you want to sell your shares and he's willing to buy them at X price, then when you send in the request to ComputerShare to transfer that ownership, you're reporting the price at which you sold the shares, and we record that for cost basis purposes.
Does it establish the
No.
value of the stock? No.
It does not.
If Bill Gates wants to buy my stock at $100 per share, so
It,
is that stock market?
it establishes the value of the stock for the person selling and the person acquiring for tax reporting purposes.
But not the market valuation of that.
No, because it's not a publicly traded.
Fair deal, you know. And other people
Yeah,
might say,
it's perfectly normal.
June, what about? Yeah, they have a question.
Okay, you're all questioning now.
That's it.
Would it document share restrictions?
Carmel's question is, would it document share restrictions? We do restricted to restricted transfers. That's a whole nother layer of complexity. Because when you own shares in a private security, particularly a Regulation D offering, so if the offering was done under that exemption, the shares are generally restricted for a period of at least 1 year from the date of the closing of the offering. Regulation CF has a similar restriction. Regulation A are fully tradable. When you have restricted shares, we need a letter of opinion, either from the shareholder who's selling the shares. So if Jean's shares were restricted and Uncle Charlie's buying restricted shares, Jean's likely to have to go to a securities attorney like Michael. Michael will help you here, to get a letter of opinion as to whether the conditions required to lift the restriction have been satisfied.
Wouldn't that be filed with ComputerShare? If I have an account with you a bunch of issuers that need help. Going to this BC round and it's a nightmare. The cap table is looking like a disaster.
Oh, that never happens.
I'm scared. And I propose for them to go to you. Couldn't they document all the restrictions of debts
Yes.
with your system and it just automatically flags if there is someone that
Yes.
wants to sell privately? And then I can just
Carmel's question is, if the shares have restrictions on them, does our system accommodate that? When the shares come into us and we convert in the records of who owns what, there are different types of restrictions that may apply based on the security, how it was offered, and so forth. Some shares have more than one set of restrictions on them. There's many instances where you see a share position that has 2 or 3 different types of restrictions. So you might see a 1933 restriction, a company lockup. There's all kinds of different types of restrictions. We have a legend library, actually, because it used to be when you issued paper certificates, you literally printed a legend on the certificate so that if someone took it to a broker, the broker would know that the shares weren't negotiable. So in the book entry world, where the shares are electronic, we record the legend electronically, so there are codes, and then there's an associated text that goes with it. When you have legends, removing them is really the fun part, because, again, depending on the type of shares, who bought them, who's trying to sell them. So are you an affiliated person? Are you a director, an insider? That usually comes with more restrictions than if, let's say, Jean was an unassociated person and simply an investor with no other relationship to the company. So there are different types of restrictions based on who the buyer originally was. And our system records them. Generally, I would say that there's not a lot of restrictions that get automatically removed. There are some. So if a legend is going to expire on a certain date, like if there's a vesting, for instance, on an option grant, then what would happen is in our system, what happens is after the close of business on the day of the expiration, the shares get taken from the restricted bucket and moved over into the free and clear bucket. So they're ready to go the next morning if someone's dying to sell them. But generally, removing restrictions requires a letter of opinion, either from the issuer's counsel, or if you're the shareholder, in the case of Jean and Uncle Charlie's transaction, Jean might have to get someone to give him a letter of opinion that it's okay for the shares to either be transferred or sold. Now, keep in mind, you can do a transfer of ownership and keep the restrictions in place also. You don't have to remove the restriction to transfer.
Isn't there a natural progression for computer share to perhaps, if you have all that data,
Mm-hmm.
to put it into, say I own shares, and I will say, I want to sell it, and I tick a box, and you put it onto an exchange that is maybe owned by computer share, or maybe not. Isn't that something that you guys would do?
Carmela's asking if, with the data that we have, can we basically create a secondary market?
I permission you
Mm-hmm.
to help me just put it out there.
We don't simply initiate a sale, and keep in mind also that when you have certain types of securities, it's a little challenging sometimes to get them to be available for sale in the open market. So although you might want to sell your shares, if the issuer of those shares has not taken steps to either list on an exchange and put that out there, or if they haven't registered with OTC to get a CUSIP and a ticker symbol for their stock and make that available to market makers, then you might wish every day that you'd be able to sell your shares, but if they're not ready to go to market and there's not a sale facility, it's not something that we really facilitate. It has to be initiated by the seller, and it generally also has to be aided and abetted by the issuer.
So say I am the owner of that share. I want to commission you to release a record that I actually own it.
Mm-hmm.
So just to verify, so it just helps reduce some of the legal fees involved in verifying.
You need two things. You need, as the seller, the right to sell the shares, and the securities laws may prohibit you from selling those shares at the time that you would like to. And number two, whoever is the seller, whether it's the company selling shares to its initial purchasers or a shareholder selling her or his shares to a subsequent buyer, they need that buyer. So the issuer needs to be able to sell the shares legally, and the buyer needs to exist who is interested in buying those shares. And by the way, this area is the most important area of information, questions, and answers in crowdfunding, equity crowdfunding, of every single one. Because y'all realize what we're talking about? We're talking about the investor. And all too often we go to crowdfunding conferences or EB5 conferences, nobody's talking about the investor. There are issuers, they want the investor's money, but they're not thinking about what does the investor want. What the investor wants is the fruit of the investment. They want their investment back with profit. So the way the investor gets out of the deal is ridiculously important and should never be far from your thinking, even if you're not the investor and you're looking for the investor. Because you've got to make the investor say, not only do I love this business or this product or this service, but I love the way I'm going to be able to exit. I'm going to make money off this business and I'm going to be able to take that money home.
That's what she's saying to Joan.
Exactly.
Establish a channel.
This is the way.
Only they have established portfolio, record, stocks, and all these things.
Yep.
Establish a channel through the OTC or McKinsey or whichever way you guys have the established names, so that those stocks can be traded or can be exchanged, or whoever wants to buy and sell, it facilitates the issuer to make that happen. It will help investor.
Exactly.
Illiquidity is one of the issue. Investor doesn't want to come close to this one.
So remember, if you're the issuer and you want investor money, if you tell the investor how you're going to take care of him and how you're going to get him his money back and when and all, you're going to be more successful because that investor is going to be able to say, wow, you've thought it all out. You've answered all my questions. I know what I'm getting into. And you know what? This is a strategy for me doing well that I'm willing to embark on. I'm going to invest in your opportunity.
Michael, you and John can work together to make this happen. Yeah, please do.
And
we will finance that operation.
That was very useful. Let's kind of go into another subject. Thanks, by the way. Thanks, June. Thanks, Michael, very much. We'll go with it. We got to kind of ask some opinion here, because that's our. We have half an hour, so we're going to have some opinion here. John, I talked to you earlier, and if you stay a little bit here in front of the camera here. You mentioned that you're in this new cannabis industry, but it's different for medical. Tell me more about your company and why you're here, basically.
Oh, well, a couple of reasons. Crowdfunding is a way for companies in this industry to raise funds because they obviously can't go to traditional sources of capital, and they certainly are going to have a very difficult time going to traditional banks for bank loans and working capital lines of credits and things like that. And so a lot of companies have really great products. They've got good demand for their products, but they don't have access to capital where they can scale their company. So that limits what they can do as far as growth is concerned. In my case, I'm a co-founder of a natural health product company. We have a very strong team of people, and we have formulators on our team. We have marketing people. So we have the product development. We have customers, and my role from a finance standpoint is raising the capital so that we can achieve the revenues that's before us. An example of that is the pet medicine market, and there's apparently a big demand. I wasn't aware of this until recently, but there's apparently a big demand for a natural health supplement that can be given to dogs and cats for separation anxiety as well as chronic pain, and we've got other therapeutics. We've got other. I wouldn't say Valium type, but still, epilepsy, bone, skin cancer. Those are irritable bowel diseases. Those are different products that we are going to be creating for that market. And that's just on the pet side. So we also have a long list of other products for humans. So there are products that can benefit humans as well. So that's what we're looking to achieve.
So, and you're a bank. You come from banking industry. You're ex-banker, correct?
Yes, that's correct. I started my career in the banking industry, did commercial lending, working capital lines of credit, mergers and acquisitions, LBOs, which were leveraged buyouts that were popular back in the 80s. Yeah. Corporate finance. I'm sorry? Private equity, yeah. Hedge funds. Hedge funds are, yeah, they do a lot of those type of transactions because they can go out there and borrow a lot of money. Corporate finance, I also worked on a lot of syndicated loans.
So you have optimistic about this whole crowdfunding as a bank?
It's a possibility, yeah. Like I said, if you can't go to the traditional sources of capital, even a lot of venture capital funds, there's actually a couple of them that were specifically set up to invest in that industry. But again, that's just a very small number, and the majority of venture capital funds are still concerned about the industry because of the conflict at the federal government level with regards to the legality of cannabinoids. You've got the DEA that made one that still considers it a Schedule 1, but then you have the Department of Health and Human Services that has patents on cannabinoids for humans for medicinal purposes. So even at the federal government level, you have two different agencies that disagree with one another.
Well, thanks, John. Thanks for being in our conference. Now, can I ask, you're here, introduce yourself to the audience. I know, but just give us you were here in the just second day. What is your opinion in 5 minutes or 2 to 5 minutes?
5 minutes. Well, actually, I.
Well,
actually, I do have a question for all, because in terms of regulations of equity crowdfunding, my idea is like the less regulations, the better, because the market of equity crowdfunding will reach its equilibrium itself. So now the question is like how to, when more freedom is given to the market, then a lot of problem will appear. Now, for example, one problem is like how to balance the issuers' fundraising purpose and investor protection. What's the government's role here? So my question is like, you are all the frontier in this area. I would like to know how effective the current law is and regulations. What's your opinion about that? If something needs to be changed, what should be changed? Yeah, please.
When the Jobs Act was being considered by Congress, various aspects of it being considered, everyone was terrified of fraud. They all said there's going to be fraud. Oh, this is the worst thing that ever happened to the securities industry. And all the states, when they tried to pass Title IV, were so concerned about their citizens, and this is going to be fraud. And to date, correct me if I'm wrong, Michael, but there's been very little fraud in the crowdfunding business.
Yeah.
And here's why, in my opinion. There was an offering on Kickstarter one day of a video game. As people know, many video games have been very successful on Kickstarter because most of these video games already have a huge following, and they just come out and say, would you like to invest in this video game, and put in $50 and you get the game. So they're basically pre-selling the game. Well, some fella saw that, and he posted his game, and within 24 hours, somebody said, well, no, that's the same code as another game. It's a fraud. Within 24 hours, they caught the fact that this guy was fraudulently trying to do another video game with somebody else's code. And the reason for that is you expose yourself with these crowdfunding offerings, you expose yourself to a tremendous number of people. There was an offering on SimBid, which is a European crowdfunding portal, and the guy had an offering on there, and somebody said on the chat board, no, this guy cheated on his wife. And everybody took their money back because you expose yourself to a huge audience. Now, you've heard the saying, you can fool some of the people some of the time, but not all the people all the time. And so that's what you're exposing yourself to with your offering. So there's actually, relative to a lot of other things, there's been less fraud in the crowdfunding world. So to answer your question about what kind of regulations do we need, it's being very well done, I think, so far. I think it's being overdone. because they should just say, you know, this is a very risky offering. Watch, you know, examine it fully. And this is a high level of risk, which most of them are doing, by the way. And that's really all you need to say. And a lot of offerings, as far as the ease of transaction, we've noticed on an offering that I'm helping with right now that people begin to do the investment, and then they see the thing where they have to put in their Social Security number, and they stop. So we've got a number of investments on this particular offering where the people started the procedure, and then they saw, well, no, I'm not gonna put any money in that if I have to give them my Social Security number. See, so that is an issue as well. So the ease of the transaction. Give me your name and your email address, and here's your money. Here's my checking account. Thank you very much. My Social Security number and my birthday and where I live. I don't think so. So a lot of people get nervous about that.
Yeah. Let's just move on over here. You have more questions? Then I can answer over here. Let's go here. Then we get more of opinion here. Just
Yeah, no, I mean, I've been dealing with a lot of regulators outside of the U.S., and the common theme seems to be general solicitation, that you cannot advertise. That is an ancient rule, you know, based on you want to protect the retail investor, not to protect them from looking at a deal. Yeah, would you agree, John? I mean, it's not too.
Back when I used to raise private equity, general solicitation was so not allowed.
Yeah. Yes, so you have to number every single document.
Exactly.
Yes, and sometimes,
Memos.
yes.
Yep.
So in Hong Kong, it's still the same. More than 49, if you do 50, you're out.
Yep.
So everyone rips that number out.
you had a
So the whole point is you're supposed to protect the investor, not protect them from looking at the deal. So every regulator now and every lawyer or corporate, like a crowdfund specialist who's trying to fight these new these regulations is trying to say the same thing now, to move with the times. We can protect who's actually investing in deals by these technologies. So why don't we use it?
the technologies. So you're asking about the tech.
Well, you can use technology to make sure that investors are accredited.
Yeah,
or, you know, and
No, and that's we have the right person in here. George just joined us over here. He can tell you all about verifying investors and everything over here, and he's an attorney. So let's bring it to the George who can answer that question. And tell us first, George, about your company. I mean, your attorney that what verify investors is under the 506C.
Yeah, well, let me go back to fraud really quickly. There's what common people think as fraud, and then there's kind of the securities definition of fraud, right? And they're kind of two different standards. And one of the areas where I think the industry could get in trouble is that a lot of the early adopters, especially in the Title III space, but even in some of the other spaces, they've taken a shortcut. They've paid very, very little on the fees. They've used software to fill out forms. They haven't necessarily used attorneys, or they've used attorneys that don't really have experience doing these sort of things to just bless things. And they haven't intended to commit fraud in general. But just the fact that they might have failed to disclose something that was material to accidentally, that under securities law is fraud, right? So I think that's something to watch out for, because whenever the SEC comes down and claims that someone has committed fraud, the general public may think like, oh my gosh, this guy was fraudulent, when really it might have just been more of a technical error in securities law. In terms of protecting investors, I co-founded a company called VerifyInvestor.com, and I created it because, Michael and I have a law firm, and we have clients that need verification, and they need it, to be legally compliant, safe, and cheap. So we certainly we weren't going to be able to do that as a law firm, as most law firms can't do. So I created a different solution, and it's offered under VerifyInvestor.com. So as a dominant provider in the space for accredited investor verifications, I make the most money in that space for verifying investors. I don't think it protects investors at all. I think it's stupid. I think verification of investors puts the investors at greater risk than than any benefit. Sure, maybe you get some people that are protected because they no longer, they accidentally like when they check the box and certify that they're accredited investors, they missed it. So you're protecting against those investors that frankly lied. But for every other investor, it's a pain in the butt. And if someone was going to defraud them, now they might have their personal financial information and be able to defraud them in other matters. So I don't think it works. We do it because we have to, but I think that the law should change so that verification is either eliminated entirely or at least made far easier than it currently is.
Yeah, the question's around the portals. There's several portal companies represented here. There are others that are looking at having a portal to be able to do that. There's going to be a discussion around the legal exposure of a portal. You talked about the thing has changed solicitations to be able to put it out there. So it seems like there's an industry where there's between 3 and 7.5% of a raise to put it on a portal, to do the marketing, to drive traffic to it, to help facilitate the transaction. They have as much exposure, more exposure than the issuer. So if there could be a discussion around the exposure of the portal for marketing, for just putting a presentation up, why would the portal be responsible if someone said when something versus if in their PPM and they get sued for that or something else? So the exposure of the portal versus the actual issuer and the differences.
So the question was exposure of portals versus issuers. I'll take a stab at answering that as efficiently as I can. Who are the lawyers in this room right now? Okay, so those are the other folks that they should answer. When you defend, when you talk about portals, I think it's important to classify what you mean by portal. Is it like Craigslist? Is it like crowdfunder.com? Is it like a Title III portal? Is it Title II portal? Right.
For instance, CubeChain. We are experts in a particular area, blockchain.
Right.
We have some expertise in looking at blockchain startups and the value that they have or may not have. So we're looking at assisting the blockchain industry in putting up a portal so that startups in that area have a place to go to where they know people that want to invest in that industry go to.
Right. Well, again, it goes back to it's case by case analysis is the real answer, right? And it depends on what type of portal you are, what licenses you're operating under. There are a lot of portals now that probably violate broker-dealer regulations because they're not broker-dealers, but they even though they don't take a commission. That's right. There's some that don't take a commission, but they've done other things that essentially make them a broker-dealer. And there they have liability, right? If you're properly operating, for example, if you think most basic, someone could go on Craigslist and conduct a Title II general solicitation. Is Craigslist a portal with a ton of liability? Not really, right? But if that same issuer went to, one of the Title II portals that offered this, and that Title II portal took commissions or marketed their deals not through just like press releases, but like they really went and solicited their deals, then would that portal suddenly have extra liability? Definitely a lot more. So I think it's very much case by case, and depending on what type of portal you are, you have different abilities. Title III portals, for example, you actually have the ability to do some sort of education, some sort of marketing without making, because you're essentially registered, right? So I think that's what you have to look at. I don't know are you guys a Title III or Title II or Title IV? Or? You just want to watch your activity, basically.
Question from Michael.
Looking at the website, which I'm debating, my wife said I'm probably going to go. There's a site, on their site, there's a TV station that has a block says, do you want to put your website on our TV station? much sense is why in the hell would we want to put our website on the TV station? Is that going to cause me a problem if I do?
Well, I'm a lawyer, so I have to answer. It depends. But you know, that's kind of cutesy. But the question is, should I allow my website to be advertised on television, in Israel or anywhere? You know, the problem with especially
American website on TV in Israel, right?
right, but
Are you doing an offering now, or?
so you know, if you can advertise your website freely without running afoul of the securities laws, you can't advertise an investment opportunity without complying with the because that's a security, without complying with the securities laws, and different laws will allow you to do different things. So if you just want to generally introduce the world to your website and say that from time to time we may have information about investment opportunities, that kind of general information is highly unlikely to be considered a securities violation. What the securities laws exist to do is protect investors by making sure that actual investment opportunities cannot be invested in without the rules being followed. Whatever their rules are, those rules used to be really narrow and tight until the Jobs Act came along. And the whole reason that Jobs came along was to remove a lot of these restrictions and make it easier for people to raise money and for middle-class investors to participate in investing, which had formerly been prevented to them, foreclosed to them. So I'm sorry to give a mushy answer like it depends, but unfortunately it really does depend because, you know, according to what you want to do, it could be entirely okay for you to do that. And the instant you say, well, now I want to do that and something else, that something else may suddenly move you over into the prohibited zone. And you sure want to know that before you do it, because unfortunately the government says there's no I'm sorry, oops rule in securities laws. If you do it, they're going to whack you if what you did was wrong. And so if you can't unring that bell, don't hit it until you know ahead of time that it's something you can safely ring.
Thanks.
Reasonably safe. If you suddenly increase, you know, if you suddenly increase your marketing in ways that you haven't marketed in the past, and then you do an offering, that's not a great thing. But if you've always been marketing and you haven't changed your marketing, usually that's okay. Like Coca-Cola can keep marketing, you know, but if they've never had a commercial and then suddenly they're going to go raise money and suddenly they have commercials, that's not a great thing.
Let's have the question here. Let me go over here. Just, oh, sorry. I had a question.
So the Title III regulation crowdfunding portals regulated by FINRA, when they put a deal up there, who might be responsible? You know, I know I guess the Form Cs have to be filed, but then is that heavily reviewed by the SEC? And then can people who invest, can they come back and sue the portal, sue the investor, or the issuer, sue both? What is happening there?
There was a company in Title II that the principal is hiding in Europe right now because of fraud. And he went to, this guy went to, probably sponsored some of our conferences, and Synergy.
Oh yeah.
Yeah, so they were
never sponsored.
Oh, they were all they were
Save the money.
at all of the
No, they were not.
conferences.
He was attendee, but not
Yeah,
sponsor.
so they went to all these conferences and they took booths everywhere, and you know it was alleged that they committed fraud afterward. I don't think that's happened in Title III yet. If it happens, I think the lawsuits would naturally go against the issuer and the portal. The portal, depending on what involvement they had, may have liability, you know, or not really.
No. I mean, let me elaborate, and that's what was on the title too. No, I know. I will have you comment, and we're independently as a media company. We don't any promotion, any offering. We don't put any of them. We just reported whatever in the crowdfunding is good or bad, what it is, and we don't.
Like nice guys.
Yeah, I know.
Thought they were nice
Yeah,
guys.
no, they are.
They showed me their offering, tried to get me to
Yeah.
invest, and I looked at them and I was like, it doesn't make sense to me.
No, but when it comes to some of those offering basically, and I saw the offering, it was about the drilling oil and gas. Now with the gas prices now under the $2 in a lot of places in the state, who you want to invest to drill oil and gas? I mean oil in Texas. So I mean, so it smelled very fishy in the beginning, and I'll tell you that. As independent, we never did that, but this is just one of them, and I think SEC just jump on it quickly and find out this, and they do after that. That was very good. There was one small little bad apple. I didn't see anything else as after it happened.
And since then, outside of the crowdfunding space, how many oil and gas deals have gone bad?
Yeah.
You know, a lot more.
Yeah, that's what. So that was like just oiling, and a lot. And when we started this, you know, and we have a responsibility as a media, as an industry, and not to put anything that we feel. And I know that we, as a CrowdFund Beat and also a CrowdFund Insider, when we see something is not right, we're never over there. I mean, when it's just like anything else, like saving and loan and other thing. A lot of people, that just is like, you know, going gold rush. And there was some company started what's called crowdfunding gold crowdfunding, and you know, it was nothing was there. So yeah, that I know, but we have to guard it.
I think the key is hearing what George said. He said there really haven't been a lot of cases in crowdfunding so far. And yesterday I mentioned to you that I think we can look at EB5 and what's happened with EB5 because it's 10 years older than crowdfunding, but it's not 100 years older, but it's 10 years older. And EB5, alternative financing. Crowdfunding, alternative financing mechanism. And in EB5, 10 years ago, people thought, we're an alternative. The same rules don't apply to us. Well, guess what? The SEC has a very different view from that. And while they didn't hear about EB5 for quite a while, about 5 years ago, they suddenly appeared and they started whacking everybody, saying the rules apply to everybody, including you alternative financing folks in EB5. They're going to say the same thing to us in crowdfunding. The same rules apply to you alternative financing folks in crowdfunding as well. And I think that the experience that we can expect to see in equity crowdfunding is going to be very similar to the experience that has been the case in the world of EB5, where there is 5% of the folks who get involved think it's an opportunity to rip people off. And those guys exist in EB5. We're going to find some of them in crowdfunding. And by the way, they've existed outside EB5 and outside crowdfunding in the world of stocks and bonds and investing since well, this is why there was the crash, right, in 29, because people were buying basically smoke. And they all got ripped off, and look at the global effect of that. And the government said, never again. We can't ever let this happen again. So when George says there hasn't been a lot happen in crowdfunding so far, people are watching. The SEC is watching. It's a law enforcement agency. Not only do they nail bad guys with fees, they put them in jail, okay? And while they are slow to show up, look at EB5 and take away what's unusual. It's just some immigration stuff. What's the same is, from SEC's perspective, it's an investment opportunity. You cannot defraud investors or there will be serious consequences. On the other hand, most of EB5 and most of equity crowdfunding is going to be a lot of people trying to do the right thing. Many businesses just won't make it because that's the way businesses are, and that's a risk everybody's willing to take. But I don't think that there's anything to suggest that equity crowdfunding is going to have a worse track record than anything else. In fact, I think equity crowdfunding, it's going to have unique issues because we're dealing with middle-class investors as opposed to wealthy investors. But overall, I think there's a huge opportunity if people behave themselves exactly the same way they're supposed to behave themselves outside of crowdfunding.
There was a Title III portal that was shut down.
No, but let me. Yeah, I wanna. Yeah. Yeah.
They feel they have to be more protective of the unaccredited investor because those people are easier to defraud. Yeah. But at the same time, somebody has to do something wrong or the SEC won't hit them. So you need to see if people behave themselves because they come to events like this and they get educated and they meet other people who want to do the right thing the right way. And by the way, you can be entirely successful doing the right thing the right way. You absolutely can. It's not free, but it's not ridiculously complicated or expensive either. You can do what you want to do, right, and less collateral damage. So really, our job here, and I know Sydney takes this opportunity to give everyone the case to find additional information so that they can be in the successful group doing it right.
No, I mean, I appreciate that. I mean, that's what we do. We need to educate the public. But I go.
Bad apples in every
Yeah.
industry. Investment banking, VC, there'll always be bad apples. So it's
Yeah.
okay, one or two places not successful. That's a part of the process.
So I mean, we're in media, and I always, as an outsider, I don't have any, portal. I have an interest in some portal, mostly real estate, because I believe in real estate works. It's nothing new. Everybody gets together, they put a PPM together, LLC together, and they buy a building or something. So it's nothing new. But in this, so real estate it's been working in a crowdfunding because it's a hard asset. So I mean, basically, people say, I have part of this break, part of this building. So it's very easier for investment.
Also, they give you yield much higher than
Well,
what you can
that's
expect.
what, and that's what has been very successful. But it goes back to the project. But I go travel and I speak, different places, from China, from London, and this crowdfunding phenomenon is everywhere. So I'm not only for equity, it's been very good for rewards crowdfunding and social impact crowdfunding. Social impact crowdfunding it is nothing new. And I say wherever I go over there, I start with that crowdfunding is nothing new. Churches, synagogue, mosque, they figured it out a long time ago. When you go to the church in the end of the sermon, they pass the plate, that's crowdfunding. Government, you pay taxes, that's crowdfunding. So I mean, it's nothing new. Then in China and other countries, they call it internet finance. That's all it is. So we used to go to the Charles Schwab. We have to go to the Quick and Riley, which exists those days. We had to go see our stockbrokers and other to buy certain stock. Now we can, with $8 with E-Trade, which started right here in Silicon Valley, you can buy whatever stock you want. Same thing with investment. Do I need to know what this company did? I lost money in AOL? Sure I did. So you got to do your own due diligence. So that's what I see as far as investment. But what's worked for crowdfunding is that SBA and small businesses, they have difficulty to go and borrow money for the existing business. So that's what Title III did. It's a very small portion. They're not going to go to the IPO. But it helps to mid-America, that somebody has a beer factory and wants to export and that's what has been working. And in Kickstarter's reward crowdfunding, it works because, all of them are good. No, I've seen some of them they didn't deliver. They sold something that delivered. If I may. And so that's what Kickstarter's reward crowdfunding, but nobody comes out of it. There's a company, they do game crowdfunding, and the guys raised, it's called Star Citizen, $120 million. They haven't delivered one product yet, but so it is almost about $140 million that they. Not all of them, but anyway, and I interview some of the companies. The guy come up with some breathalyzer or something like that, and you put it on an iPhone. And right here in Silicon Valley, they didn't. But what's here in Silicon Valley is happening. It's a lot of VCs, a lot of angel investors. They use Kickstarters as market validation. Sony use for test the market. So you go out there, you see if your product works. You see what kind of or movie what we have done. So, and that's the evolving into it's a social marketing, social entrepreneurs. Is evolving too. So equity crowdfunding is part of it, and I'm glad it's very small right now because we're testing. I never worked for that 5 million right away because we got to find bad apples like George mentioned, we don't know, who's going to come into it. So this is evolving to something very good, for mid-America. I got to move on. I got to add some of questions. We only have about 10 minutes, so we'll be very quick. Let's ask a question after the market. Let me get some of those people here already. Yeah, we will. Let me go to the people that have not been discussing. So tell us a little bit about what you in the last 2 days.
Oh, thank you.
Yeah.
Well,
you're in the real estate.
I am.
Introduce yourself. Yeah, tell us.
I am. I really am thankful to be able to receive an overview of the different regulations and requirements and pros and cons associated with each one. I think that's very valuable for me and actually hopefully for anybody who's thinking about getting involved in crowdfunding because as discussed herein, we learned what we might want to do and what we shouldn't do. In addition, what we shouldn't do. And my take on it is, after hearing about all the requirements, this is for me personally, without having enough of a crowd myself, it probably is, and with given all the requirements that that I would be obligated to meet, it probably is not a good idea for me to do a crowdfunding venture of my own at this time. I think that, as shared, there certainly are a number of people that don't have their existing crowd that have been successful with different raises, and I can appreciate that. But being a conservative guy and not looking for grief, and also looking for success, I tend to make choices that are going to result in positive outcomes. And so I think that the intelligent thing for me to do is perhaps do something, if I'm going to do any crowdfunding venture, is to do something in some white label fashion where I can ride the expertise of an established player that has proper infrastructure and a crowd. And that would be a safer, perhaps more intelligent pathway for me. That doesn't mean that I'm not interested in pursuing crowdfunding as a vehicle to grow in the future. But what I need to do, I think, is focus on creating a crowd. You know, again, that's really what it's going to come from. Why are people generally going to invest in my specific venture or in anybody's specific venture if there isn't relationship, connection, and trust? And so that comes from establishing a crowd. I see the value of that. And I think that for anybody here, I hope that they might share that view when thinking about whether to get involved in crowdfunding. What an incredibly powerful and innovative platform, you know, and pathway to raise funds, but it needs to be intelligently and respectfully implemented. And so I thank everyone who's not only been a speaker but a contributor in terms of questions and comments for their wisdom and insights and information that's been very valuable for me here today. So I thank you all.
Thank you. Now, let me answer your question here. I mean, you're in real estate. Not everybody, you know, they're coming to the crowdfunding that they have to go get a white label crowdfunding platform. You know, there are companies like in real estate, you know, CrowdStreet and some other that, you know, they already been established, they're funded. You know, they already have connection with SEC, and they have lawyers. So you can go put your projects there basically, and so they syndicate. You know, so it's not just we're talking about the crowdfunding. Yes, you have to start with your own crowd. You have to be, you know, whoever is your investors, including yourself. You could go, you know, put it up, but they will bring you other crowd that you never will see it. So let's say you want to go ahead and start in crowdfunding. You don't need to do any of this portal. You go there, you put your product, because in real estate crowdfunding, they're looking for project. They're looking for good deals. No, and you know, and that's what it's all about. So, you know, and there are companies out there that are real established after a couple of years. Go over there, yeah.
If I can just make a comment.
Sure.
I appreciate that clarification. That, you know, probably my use of the term white label is a misuse of that term. I've met with the CEO of Patch of Land, and you know, I'm exploring. I haven't really seriously explored that opportunity, but that's an example that you're talking about that I was calling white label, but I was misusing that term. And so I think that also I was talking with is it Carmi? Carme. I was talking with Carme yesterday, and her suggestion, or she made some comment in response to something that I said about, yeah, it sounds like that would be a very good idea to get involved, not as an issuer, I guess is the term, not as an issuer initially, and gain some experience so that I could not make mistakes and be more likely to be successful. And so that's, I think, the direction that I'd like to go initially, and then hopefully grow from there. But thanks for all that information.
Yeah, you know, and that's what you need to do. I mean, that's what we have these seminars. We have, you know, CrowdFund Beat. We have these expert, you know, and you know, whatever you want, you're looking for lawyers, whatever you want to get some share, whatever you want to be, and so we know where we at. We know what's happened before. We know the bad app. We didn't have any bad app, one or two, but we know what's going on. So that's what, and that's what we see it over here. But anyway, thank you. So you had a question? Go ahead. We have about 10 minutes.
Yeah,
left,
I'm gonna go pretty quick, but I just kind of wanted to address things that had Gene and Jor said about a little bit about rewards crowdfunding. I got a published paper on rewards crowdfunding a couple years ago, and so I did a little bit of research into that. And fraud on Kickstarter, an early study showed was like around 3.6%, which is pretty low.
Describe the fraud.
Non-delivery
Non-delivery
non-delivery attributable to fraud. A lot of the non-delivery is attributable more to incompetence, and which is different legally, but not in the view of the people who didn't get their thing. And that is kind of the thing where I'm a little bit worried. And the question that I guess I want people to think about, because we don't have time to do the table, is who do you think should be the gatekeeper for crowdfunding? Should it be the platform? Should it be the lawyers who are helping the companies? Should it be the companies themselves? Should they self-police?
Yeah.
Or should it be the crowd? Should we just say, we'll let the market decide?
I think the SEC is probably going to decide for us.
That's over there. No, so it's three. We're talking about reward crowdfunding. We're talking about equity crowdfunding and social impact crowdfunding. So, and three different things. Let me. I think for equity crowdfunding, SEC has a good hand of everything. We have attorneys. We have people that want to work. There are newcomers coming here, so it's a checks and balances. And it's not just anybody. They check everything. And they're watching those portals. So it's portal responsibility to find out what kind of issuers are going to come to the bill. How long we have a CPA, crowdfunding CPA. So if you do the regulation, A+, you got to do your checks and balances. You cannot come offer something that it doesn't exist. So that's, and I'm very comfortable with this 1 million. We're testing it. Then we go to the $5 million, $10 million. I think is great for small businesses that they cannot go get the money from SBA and that it doesn't exist. It's not over. So, and that's what the base of the crowdfunding started was, in your community. That's what a lot of these intrastate crowdfunding is successful. You invest in the project that is very close to you. What it would be a, build. We do that. We do it with bonds right now. When you do a library, when you do other things, schools. So it's the same thing. If you see, you go buy a bread in your neighborhood, the bread company, should I invest in here? If I go to the restaurant and I say the guy wants to invest in that particular restaurant in the local, I love this place. So it works with the local community base and it's grow over there. But we're talking about a bigger scale, that goes to sophisticated investors that they know what it is, they're investors. And it's good right now we have certified investors, they want to be qualified as accredited investors. Later on, when this thing open and on the Title II, still is a lot of ways. But it's, to answer your question, it's a total responsibility, and industry and whole is a responsible. Now, for the reward crowdfunding, that's a haywire. Now, but what I see, the FTC starting, cracking down on somebody is not coming over here, and that's the responsibility of Kickstarters, Indiegogo, any of those people that they come there. GoFundMe, which is, social impact crowdfunding, they're making more than money anybody else. Oh yeah, they make money and they had some fraud. This is just feel-good stuff crowdfunding. Whatever, somebody, crowdfunding for your cat died or something like. No, it's true. And they started this company was a very small company. Now everybody put their own things over there. No, it is, and they're making good money because American, in general, we are a giving society. We love to give. We love to help. If something somewhere happened, and that's the story. And I want to be very short. There's a company here in Silicon Valley started. It's called WePay. This company is a credit card processing. When the Wall Street happened, that demonstration Wall Street in 2008, nobody was processing this contribution. So these guys, they come over here, they're starting doing, taking the credit card for them. Now it's a company by processing. So, and a lot of these companies, like I don't want to name it, in this reward crowdfunding, they see themselves as a credit card processing. But in 7%. That's all it is, basically. So I think it will be changed. So, but one thing I'm very, very proud of being in part of this is not, I love equity, I love the other thing, I don't know anything about it myself. We're just learning from the lawyers. That's why I bring the expert here. But I love social impact crowdfunding because it helps to the community. I really do. I mean, I've seen that, because there's a lot of givers, a lot of people that they want to see what's happening with their money, not just just give the money to something, to see what is happening with their money. And that's social impact crowdfunding. Thank you. Let's go quickly. We're going to be wrapping it up.
Yes, very quickly. Actually, relating to this subject about bad apples and fraud, I do believe in something every human being has, which is we call the sixth sense. When I do business transaction with someone, I meet with them at the end of the meeting, I can tell them, I'm sorry, I'm not interested. I can feel it. That's the feeling. We have not ignored that. You know this guy is right or not. My question regarding this crowdfunding, first of all, I would like to thank you for putting this together. Myself, I learned a lot. I'm a tech guy from the technology. I learned from the lawyers. I learned from the financial people, investors. It's very beneficial to me, and I will recommend it to the startups and the entrepreneur that I work with. My question is there any section that they rate these platforms? It looks like it's evolving, and many platforms in the world. Is there any place you can go where the consumer, whether investor or entrepreneur, can share their like Yelp or TripAdvisor for crowdfunding?
Yeah, and I can answer this question from you. We right now, this is a very young industry. There is no data that is available, but they're putting some data, but it's not accurate. I know crowdfund capital advisor, she's right here, Jason and Woody, with the crowdfund, and they are actually one of the pioneers. They were the one inspirational. They put Jobs Act together, in 2012, and it's called crowdfunding. They're doing some analytics, basically what portal does, where that, but it's so new as far. So you have to go do your diligence. You go to the this CrowdFund Beat that we are a media company, or listen to a lot of these video. We create this video so we have people like they could not be in this conference. They don't have any illusion about crowdfunding or Crowdfund Insider. You can go over there, take a look at it, and see what. But I'm very optimistic about this industry, and I'm thankful for people, our sponsors, Michael, Jorn, and the other people forefront they put here, and the people that you come to these conferences, that we see these things evolving here. It's a great opportunity for, as will be, as a real estate issuer, as entrepreneurs. It is a lot of opportunity, but let it not be any illusion. This is a very new industry. It's getting together to be basically good industry.
You have stats on crowdfunding that everyone, most of the knowledge at these conferences, including this one, has been crowdfunding through portals.
Yes.
And online. And in the Title IV space even, and in the Title II space, a lot of the funding is not. So out of a $38 billion Title II market, for example, in 2015, I don't even think the portals got 10% of that. So most of the general solicitation is not going through a portal and all these things. So all this advice that says you need your own crowd, etc., that only applies in this tiny, tiny microcosm that is internet crowdfunding. Outside of internet crowdfunding, it's not necessarily true you need your own your crowd. You can just have a good marketing campaign to get in front of the right people. So do you have stats on like maybe 2016, like how much of it was through the internet versus how much of it wasn't? Because I think in 2015, when I looked at it, it was something like 6% of Title II was through the internet, and almost all crowdfunding is not through any internet portal at all.
Yeah, no, and the question is that do we have any stats for the last year, 2016, who went to the internet, who is not? As you know, as far as real estate crowdfunding, they put a lot of project, a lot of offering, but they take it off once they see the institutional, they take it off the portal. So it's very hard to know who, but they get attraction in this crowdfunding. So crowdfunding itself, it not necessarily is a tool for raising money, but it's a tool for marketing. So that's what's happening. And just additional, if you have I would think if you're a real estate company, if you already have your crowd with this local, you don't want to go to national, and that's the biggest mistake a lot of people do. They want to go all around the country. It's difficult. you got to be still, I believe we have to meet each other. We have to feel each other, like you mentioned. You have to, travel to meet your investors. So that's people comfortable. And that's what is happening in Silicon Valley. A lot of investors the people who get, wealthy in here because they pass by and they see a new building, whether it will be LinkedIn, whether it will be Facebook, say, whoa, something is happening. These guys aren't hiring. But there's no data as far as, 2016. But there are educational tools that, one of them you publish, that, for the crowdfunding, what the steps going on, that you gave it to us. That's very important, That's what is right now in this time.
Launched their portal when they had 0 crowd, and then the first issue they had 0 crowd. And that first deal, they got their first investors, bus ads. They funded the first deal from the community because that community wanted senior housing, had a shortage of senior housing, so they just took ads on buses. The buses went around, and that's how they first built the crowd.
Yeah.
But they built the crowd. It's not something you can't do.
Yeah, no, that's true. And I know, and without naming, I know a couple of them, and I never, like Realty Mogul. When Jillian, when she started, basically, she because they wanted to have these internet works, basically. So she paid investors to go and invest, in the portal. So see the HC work and the lawyer work. So that's what they did earlier stuff. So they went to the investors. You know what? I'll pay you if you go over there and invest through portal. And so see working. But now what's happening is basically they take a lot of them. Not only that, a lot of companies are taking out of the portals. So it's there. But real estate is very big. But I'm very optimistic about for accelerators. Not particular startup, because when somebody go to the accelerators, and they're in the next level, but I see crowdfunding as far as between seed and the Series A, so that gap funding, and it works basically because, when you get your seed until you go to getting that Series A, that gap, you could bring investors, you can go to the computer share, so then they go to the next level, you already have your checks and balances together. Michael?
That's an area where there's a difference between EB5 and crowdfunding. EB5, you're dealing with foreign investors. They're putting in a huge amount of money per person, 500,000 or $1 million. It's going to go up. They want to invest in places in the United States that they've heard of.
Yes.
We had a $250 million, 4 seasons resort, fancy schmancy luxury glam, real estate development, great project. Everybody in the U.S. loved it, located in Puerto Rico. And darned if the overseas investors never heard of Puerto Rico and had the hardest time ever coming to believe that Puerto Rico was part of the United States. If I have to invest in a U.S. business that's creating U.S. jobs, how does Puerto Rico count? And you're thinking, oh, come on. So the EB5 investor has heard about Hollywood, he's heard about New York, he has never heard about Idaho. On the other hand, the crowdfunding investors, many of these people are looking to invest, some of them online through the internet, and others are saying, gee, I'd like to invest in downtown LA because I live in LA, or I would like to invest in St. Louis because I'm in Missouri, or maybe I'm in Idaho, or I'm in Puerto Rico, and I want to invest now that I'm a middle-class investor. So now I can invest. I don't have to be accredited. I'm an unaccredited investor. And the way that you find your crowd is by talking to your neighbors. Okay? It doesn't have to be online. It can be going through your local government. It can be going through agencies that are there to finance businesses, your SBA offices. There's an awful lot of work that people can do successfully in finding their own crowd without going online, but by going local. So don't forget, you don't have to be a high glam destination to be successful in crowdfunding. You do in it's easier in EB5. You don't have to be, but it's easier. But in crowdfunding, you don't have to find strangers. You can go find people in your community who say, we need a football team. Look at this great stadium over here, or over here, wherever it is, over here, right? This is a great stadium, but there's no professional football team playing there on the level that, well, maybe the Chargers will go there. How? Because people are going to say, the community wants this here. We want this to happen. At the end of the day, remember, it's crowdfunding and not EB5, so you don't need jobs to get investors' green cards, but you still want jobs in your community. And so job creation comes in non-EB5 projects.
So look to your community, look to your neighborhoods, look to your professional organizations in your town, and you can find yourselves finding your own crowd that way, and they're looking to fund successful businesses in their own community because it's good for their community, and by the way, they're going to make a return in return.
Yeah.
That's magic.
Well, that's what, if I'm going to go back over it, that's what quote unquote Warren Buffett, invest within 50 miles of your area, and that's
Right.
what a lot of people do
Right.
over there.
Right.
I have a question since I'm here to learn. What then, thinking from the real estate world, there's this syndication that's been around for years and years and
Yeah.
years and years. So my question to you is to the comparison of the parameters of a syndication versus a crowdfund. I see so much similarity between the two.
Mhm.
So I'd like to know how would crowdfunding be better than syndication? Because you even talked about your own community. Most syndications, the people, when you do it, it's usually within your own community.
Yes.
So I would like some comparisons and contrasts, because I know how a syndication works. And from what you're saying, it's how crowdfunding works. It's almost similar.
Yeah.
Yeah, that's what it is, and let me make it very simple here. One of the site, basically, GoFundMe. It's basically feel good. You wanna raise for the baseball team. You want to be with your new company. You want to raise money for the football team, and or you want to get married. And you want to have a set of uncles. Somebody send you some gift. You want to raise money. And so it's a lot of it. So it's just the internet finance, they call it.
Yes.
But let's say the kids, they go, and these days instead of going door to door or selling lemonade that we used to do that to raise money, and they go over there and they put it, well, why don't you contribute to my campaign, and that's that. And social networking with with Facebook, they all have it, so multiply. Everybody gonna put $10 or $20 or $30, So that's what is door to door. Same thing with syndication, and you're talking about the real estate. You're just expanding. People go to the internet now, and that's what's happening. This is finance, and June can say more about this because she was, old-fashioned, and banker and other, not old-fashioned. I know from the old. Well, I was gonna say old-timer, but old-fashioned. But I made it. I changed it to the fashion, and but she can say, use. That's what is internet finance is all about, basically. You go through internet, and this year, as you know, Macy's closed down a lot of stores. Basically, people do not go to the stores and shop. The Black Monday or Happy Monday, what they call it. It's happening because a lot of people go online, and it's very easy for them to shop. So this same thing with the where you want to do syndication, you just give it to the people, then they go here, and if they get comfortable because the ACH, verify investors, attorneys, and shares, they go over there, and a lot of these sites is comfortable. They have done it. They put about $500,000 easy. They don't have any problem to click to put $500,000 or $1 million to that level to those internet. That's how it is, basically. Going.
If you think like in the syndications that you're doing, is it a limited partnership organization? How is the syndication organized?
There's my CPA.
Let me make two comments.
Sure.
Since
Just quickly, yeah.
Since I've been on both sides of the coin, I've done auditing where I've done IPOs and things like this. I think people here have missed a couple points. One, I've been on offerings where we've done stuff, well, not stuff, offerings where basically the comment has been from the client, the printer is made more than the attorneys and the accountants. You turn in the, quote, the red herrings, and hey, the red herring gets printed 3, 4, 5 times because the SEC doesn't like A or B or C. And I got a little bit tired of auditing. That's why I ended up doing a lot of tax work. But I think one point people here have missed, I've done a lot of consulting now where people bring me offerings, look at this, look at a LinkedIn offering, or look at this, and people say, hey, how good is this, the quality of this? Look at windmills, look at vineyards, look at oil deals, look at all the offerings. What is the quality of this? How good are the projections? So when people are putting together these your deals, so let's just call them deals because they're all deals. What is the substantiation of the quality? As Sydney says, real estate, you got a building that's not hard to value. You got a movie. How can I tell what the value is of the movie and the quality of the movie? That's hard.
Even the pros can't tell.
Yeah, no, that's hard to put a value on. I mean, you could say it's 0. I could say it's 1 million. Who knows? To be determined.
Big Disney film just bombed something terrible, lost $100 million.
Right. So so things like that are it's an unknown, but there are things that are hard assets that you can value. Oil wells. Who knows? The price of oil was $100 a barrel. Maybe now it's 35. They're talking. Some people say it's 50. People buying gold. So when you're putting together projects or his nutrition, who knows? You're dealing with the government regulations. But I think when you put together these deals, you've got hard assets that you can put a value on. Being a CPA, we can count beans and say, hey, the beans have got a receipt and they're X dollars, so I can value that. I've audited walnut orchards where the value, I fought with the guy because they talk about the lower of market versus the cost, and the walnuts went to hell, and the price of walnuts and the market were less than what he paid, so the inventory got valued at the lower cost or market. And that's the first time I ever run across that situation. But I think when you have syndications, or if you have your portals that Sydney and your solar, that's an unknown, could be worth millions, could be worth what your time and your effort. But basically, the other side that nobody's ever mentioned in yesterday or today, and I think it comes into play, particularly in government regulation, is the tax aspect, because you got solar, you got buildings, how they're going to be depreciated. Are you going to depreciate them by parts? Are you going to depreciate the whole building? How are you going to value the land? Are you going to depreciate the building separately? The cost of the building? These are all things that you got to, I think, make known. And hey, this is, we got a 35-year building, we got a 27-year building, we got guts in the building that are going to be depreciated over 10 years. And all these things that are being done, your movie, hey, how are we going to approach that and what we're doing this? Because when people are looking for a way out, just like we're talking about, hey, we got a channel. You want the channel to get in and to get out.
Perhaps what you're trying to say is that actually these crowdfunding sites, it's a good way
Yeah.
to, it's like an online due diligence. Right?
Yeah.
So you
But
can go in.
people want a way out, and you got to say, hey, this is my way out, and this is how I'm going to get out. So you say, hey, no one has talked about it all. We got a tax aspect and we got a hard asset aspect, and this is your way out, and this is known quantities. You're going to get a tax benefit of X dollars, 1, 2, 3 years, and you got X dollars that you could sell tomorrow because you got a building here that's known. You got a movie. Who the hell knows what it's going to be worth?
So you want a disclosure document.
Wow, I like that, and I would love it if I may have it there. You know, everybody loves California in a way of it because it's the land of frontiers. It's entrepreneurs come here. They take risks. Years ago, they came with the wagons. They came here in the land of opportunity. I came from another country here, and that's what the land of opportunity. You cannot, and that's a good thing. But entrepreneurship is a risk. It's in your blood, and that's what we built this country for. And crowdfunding is just another vehicle. You still have to do your diligence. You have to hire an attorney. You have to go to expert. You got to go by the rules, but you still have to have the guts. Investment. You're talking investment is a risk. Whatever you're getting married, whatever you're, it's a, I have to, so it's, I throw that over there. And that's another investment. So in a way, in your life over there. Of course it is. And so it's investment is a risk, but you cannot be afraid. As long as you go to the good lawyers and good, CPAs that we have, you go by the books, you pay your taxes, you pay That's going to be. Would it be a failure? Why not? I go and, teach, the kids that, and I still call them kids because 21, 22, and they failed in their business. I said, you know what, you're not a failure. And, they come get together because that's experience. They get experience. Next time around, you don't make the same mistake. So this is what's nature of the entrepreneurship in Silicon Valley is. And crowdfunding is just an element of it. Whatever have your dad write a check for you, whether your uncle will do it for you, whatever will another investor do it. You show me how you can do. And I go and sit down, and I've been doing with Credit Suisse First Boston. I was one of those people. People come to us and want to borrow money, in the heydays of the Silicon Valley. We give money to people that not in education, they had that, drive, that passion, but very, they had to go organize what they had just together. But you're right. One of the problems, that's for another story, we're running out of time. One of the problems, this is a new industry. One of the problems that, we have to solve is its exit strategy. And we don't have it in crowdfunding. And that's for another discussion that is, we don't have the time. But I want to get last word from June, last word from you. Guys, we went out of time. But that's why I said earlier today when you said this is a very good for us. I love this discussion. And I would like to do it in the first day, then the second day. We always enjoy that in the national. We have another conference in the National Press Club in May 4th and 5th in Washington, D.C. I highly recommend it. Watch this video. Go to CrowdFund Beat, CrowdFund Insider. Seek these knowledgeable Jor, Michael, and I know June's going to be busy. When you get to that level, they call. But call me. You have any question, we'll be glad to answer it. June, last word.
I think I'll go back to your question about the syndication because, in essence, it's not different. Think of crowdfunding, as Sydney was saying, internet finance. It's a tool. So the fintech aspect of this is that you can gain some efficiency from doing things on the web that you used to do in paper, that I used to do in paper. So instead of going and having someone fill out a physical subscription document, give you copies of their tax returns, there are crowdfunding portals and or broker-dealers that can facilitate the collection of that information and do it electronically. Now, a lot of people lump crowdfunding into everything under the Jobs Act, but the fact of the matter is, as Jor pointed out earlier, Title II, which is the Regulation D, 506B and C offerings, that's been going on since Christ was a child, and it will continue to go on, and that is the bulk of money. The truth is a lot of those are being done online. Many more of them are not being done online. So part of the issue here is how you choose to think of crowdfunding. I think people think it's lots of investors putting in small amounts of money, and that's sort of the basis of the Jobs Act. But the fact of the matter is that the bulk of offerings that will be done under the Jobs Act rules now are still going to be more high-ticket, accredited investors. They're offerings that are your traditional private placement. And the internet is a vehicle or a tool for making that more seamless for people.
Yes, if I can add one. I truly believe.
Let's just start right here. June, last word. We go just right here.
Good conference.
Thank you, George. Thanks for support.
Well, I think everybody needs to keep in mind that crowdfunding as an asset class is very risky. And so the expectations going into it, again, people have to realize that, this is not investing in Coca-Cola or ExxonMobil or anything like that. And yeah, you can still lose money even in those cases. And, yesterday somebody mentioned the statistic that 90% of new businesses are going to fail in the first 5 years. So again, when we talk about asset allocation, asset classes and all that, and this is just a 5, 10, 20% of money that's play money basically for some of these high net worth individuals, that they can afford to lose it. And, if they make money off of it, then of course, more power to them. But you kind of have to put that into perspective.
Thank you, John.
Very quick comment. I truly believe we are seeing a democratization of the financial industry. They can be next Amazon.com in the financial industry. It needs a person like Jeff Bezos who drive to make this happen. I'm wishing and hoping Cindy Armani is that guy.
Hey.
I'm just doing my part.
Yeah, I just want to clarify, like crowdfunding, I mean, it could lead to an asset class, but crowdfunding isn't a type of capital. It's how you solicit capital. So I think it's wrong to say crowdfunding is risky. Deals that crowdfund might be more risky, but really it's the deals are risky, no matter how you find them. Some deals are safer and some deals are less safe. But just because you crowdfund does not mean that it is a riskier asset. And I think that's very important to know, especially since, through Verified Investor, we're doing a ton of deals where you've got governments investing and you've got the World Bank investing. And I assure you they are not investing in what they think is extremely risky. They're investing in crowdfunded deals of what they believe are extremely stable deals. One of the big three automakers is issuing commercial paper. Most automakers, no, not big three, a European automaker that is of one of the greatest brands is issuing commercial paper. Most automakers register these. They're choosing to do this as a 506C. Is that safe? It's pretty darn safe. So I wouldn't go and teach the industry that crowdfund is dangerous. I think it's a good thing to teach the industry that some crowdfunding deals may be dangerous. You have to look at each deal.
Well done, Joe.
Yeah, that was going to be my summation too. What Joan said, what Jor has said, this is really essential. We all get caught up in the magical mystery, wonderful tour of equity crowdfunding and how sexy it all sounds. I can get here from LA by air or I can get here by driving. And really that's what crowdfunding is about. Who can you reach and how are you going to do it? But at the end of the day, how I got here is way less important. Not that it's not important, but it's way less important than the fact that Sydney puts on an awesome show, okay? And that you're not going to get unless you get here. Crowdfunding is how do you get here, okay? And who's helping drive with you? Okay, now you've got unaccredited investors as well as accredited. Although you're still able to reach accredited. Don't forget, it's just a means to an end. 90% of what is really the key to a crowdfunded investment is the same thing as to a non-crowdfunded investment. Does the investment opportunity make sense? Is this business worth the risk of an investor putting his or her hard-earned money into it or not? None of that stuff, which is really the heart of the investment, is changed by the mechanism in which or through which investors were introduced to that investment opportunity and were able to put their money into it. So, let's keep in mind what Joan and Jor have said. Crowdfunding is an avenue. It's a means to the same end, and therefore all the same rules apply except in those rare areas where a plane is different than a car. And don't get misled. And remember, your investors at the end of the day, it's not about how they get to the deal, it's is it a good deal or not. That's always the same. It's always been the heart. It's always going to stay the heart. So really at the end of the day, I think there's less different about crowdfunding than people think it is. And your opportunity is to say to them, hey, don't get diverted here. Keep your eye on what's really at heart here. What's at heart here is it a good investment that makes sense to an investor? That's the key takeaway, I would think.
Thank you.
In 1930, 8% of the people in America had a refrigerator. 10 years later, and this is a time when you had an ice box in 1930. People had an ice box, but some people, 8% of them got a refrigerator. 10 years later, only 30% of the people had a refrigerator, even though the refrigerator would make ice and you didn't have to depend on the ice truck coming by every week. So what this industry needs is some successes. It hasn't really shown tremendous success yet. There have been one or two where they got some money. But what we really haven't seen is a tremendous surge in successful investments. And I think once we see that here in alternative investments that are internet, basically what we're talking about with crowdfunding is alternative investments that are funded on the internet. And so what we need to see now is success in that, a number of companies that get money and succeed after they get their money. And so once we see that, I think this industry it'll be totally transformative to financial services in every area. And thank you, Sydney, for a wonderful day. Thank you, Sydney.
If you can add, we are tapping in.
Thank you very much.
3% of people are not participating in this.
Thank you thank you very much. I want to thank you for being here very much. I know you're traveling. I want to thank especially to my sponsors, Michael, Joan with the computer share, and so the other ones that couldn't be here today. But this is because of you guys that we put this event together, and I wish you all the best. Thank you, and safe traveling. Thank you.